Hello there and welcome to Money Talk. I'm Ted David. Today I'm joined by Adrian Hardman, Associate Editor with Financial World Magazine, for a look at an always timely, always touchy topic, life insurance. You mentioned life insurance and the questions are endless. What's the difference between term and whole life? Who really needs life insurance? And how do your insurance needs change as you and your family get older? If you have a question, give us a call now. It's 1-800-752-CNBC. Good to have you here.
Thank you. Nice to be here.
We didn't put in the intro, but perhaps true also, sometimes you mention insurance and people's eyes glaze over. The insurance industry may not have been its own best friend in what many people perceive to be a high-pressure kind of sales technique that leaves a lot of people, if nothing else, confused when it's all over. What's the best way as a consumer to really sort out the wheat from the chaff when it comes to insurance?
I think the best way for a consumer to really think about it is that there are only two times when consumers need life insurance, and they need to keep that in mind always when they're listening to the different sales pitches that they will inevitably get. The first time would be when you've got dependents and you've got to take care of them. When you're married, you've got a spouse that needs to be supported, or you've got kids that are underage and need to be brought up through school and such. Or when you've got an illiquid estate, say you own a small business and it can't be easily liquidated, or you are a real estate tycoon and you've got your money tied up in assets. So those are really the only two cases when you need life insurance, and consumers should always remember that.
So if you're single, if you have no dependents, if you have no family that you wish to take care of after you're gone, you basically only need that which will cover your debts and pay for your burial.
That's right.
Okay, moving up a step. Let's say you're 20 years old, you're just married. What should you be looking at?
Do you need life insurance? I mean, do you have a mortgage? Do you have kids yet? No, you don't. So unless you're unable to save in any other way, I would say invest whatever money that you would put into life insurance into no-load mutual funds, into, you know, just savings bonds if you want to. Anything, but you don't really need life insurance, so why buy it?
The key here, am I hearing you say that generally speaking, insurance is not an investment?
Generally speaking, insurance is not an investment unless you have absolutely no ability to save, and then you need to get those monthly statements or those yearly statements that say, we've got to have your premium or you're canceled, and that forces you to do it. So then, you know, for people like that, it's fine.
I'm sure we're roiling the industry here. Let's get a question from Bob in New Mexico. Welcome to Money Talk.
Thank you. I'm interested, there's been so much talk recently about the bad effects of universal life. I'm just wondering if it would be better to go from a universal life to a term-type insurance. Thank you. I'll listen on TV.
Well, Bob, first of all, I'd want to know how old you are and how many dependents you have and that sort of thing. Term insurance makes a lot of sense, especially if you don't have all the money to put into big premiums for universal life. You can take what you save on the premiums for a term product and then invest it into mutual funds, and you'll be much better off. The thing about universal life is it is a little bit more flexible than whole life because you can vary the premium payments, and that varies your death benefit. So if your cash flow is not as high as it is typically, you can cut back on your premiums, and that will help. But still, I think if you're a young guy and you only need a death benefit for a certain period of time, say to cover some kids that are growing up, term is really a better way to go.
We've talked about 20, 25 and just married. Let's move it up a little bit. 30, 35, married, no kids yet.
Right. That's really the time to start thinking about life insurance, because then you've probably got a mortgage, you've got a spouse that may or may not be working. You want to start planning for your financial future, and so that's a good time to start thinking about it. And that's a time to start confronting the idea of term versus whole life. And then you want to decide, well, are you someone that can save? Are you someone that cannot save? And that really is the critical question there.
We talked earlier about eyes glazing over. That's when mine glaze over, when they try and give you the pitch about whole life and what is whole life insurance in English. And since you're not a representative of the insurance industry, perhaps in layman's terms you can explain it.
Whole life is a permanent death benefit. Okay. And what you do is you pay big premiums that have a lot of costs that are really padded into it, to cover the cost of marketing and to cover the insurer's cost of selling you these policies. And it covers you for life. You have to pay premiums for life. And you've got a set death benefit, and you've got a set return on your income as well, which generally is not very high. Term is different. Term is for a specified period of time. It's generally for 20 years. The premiums are much lower. The costs are much lower. But at the end of the day, at term life, you do not have a cash value built up in your policy. Whereas with whole life, at the end of the day, you do have a cash value built up.
You can borrow against that?
You can borrow against it. You can liquidate it. You can take it out after after all your kids are grown up and your spouse is self-sufficient. You can take out your cash benefits.
But could you have done perhaps better against the S&P 500 or something else in some kind of an equity investment or
almost
even
without doubt.
Fixed income.
Oh, yeah, almost without question. You would do better by investing in the stock market, in mutual funds, in tax-free bonds, in in e-savings bonds.
Double E bonds.
Yeah.
All right. Okay. Blanca in New Jersey. Hi, welcome to Money Talk.
Thank you for accepting my call.
Sure.
My husband is 38. I am 32. We have 2 children. In 20 years, they will be out of college. We just surrendered our whole life policy to buy a term product with Primerica. And all of a sudden, we've been swamped with calls from insurance agents wanting to come in and sell us some product. Now, they're telling us, okay, that we've made a mistake because we've surrendered our whole life policy and we won't have anything in 20 years.
Somebody's selling your phone number, first of all. Okay, what's your question?
Hello?
Yeah, what's your question?
My question is, have I in fact done a mistake by surrendering our whole life policy to buy term?
Blanca, can you save that additional money that you're saving on
Yes.
your term policy?
Yes.
Then you unquestionably have not made a mistake because you've got kids that you're trying to take care of for 20 years. And if something happens to you, you need that death benefit until the kids are taken care of. But if you're saving the money from your premiums on a lower cost term policy and investing it into, say, a no-load mutual fund or a low-load mutual fund or anything any other vehicle that you choose to invest in, you have unquestionably made the right choice.
All right, I hope you feel better, Blanca. Let's from Texas in. Hi, Robert, real quick.
Hey, good afternoon. My question is it possible or is it a good idea to get a second life insurance policy in addition to the one that I have at work?
Okay, interesting.
Well, what they say is that generally you need to have anywhere from 7 to 10 times your annual income covered in life insurance if, in fact, you have dependents to support. So say your policy at work covers 1 or 2 times your income. What you'd want to do then is get a policy that would cover that remaining part, that remaining 5 times or 7 times, so that you do have enough to cover your dependents if, in fact, you were to die.
Respected names in the insurance industry. It is the second largest insurance company in the country.